So now moving on to the BC flipping tax. So this is a much longer piece of legislation. There's 110 sections in this act. It's a whole standalone tax scheme, a brand new tax scheme, and it has a very long name as well. The Residential Property Short-Term Holding Profit Tax Act. In my paper, I've shortened this to the RPPTA, which is still long, but there it is. This tax was enacted with effect from the beginning of 2025, so it's relatively new. And at a high level, this tax applies to a person who has disposed of taxable property, as that term is defined, less than 730 days after acquiring it. So we now have, under this act, it's a 2-year test rather than a 1-year test. The result of being caught under this tax is the taxpayer has to pay a tax of up to 20% on their taxable income on the disposition. So why I say up to 20% is the way that this works under the Act. The tax rate, if the disposition occurs in the first year of ownership, from day 1 to day 365, the tax will apply at a 20% rate. There's then a formula for the second year, which effectively reduces the rate of tax that will be applicable from 20% on day 365 to 0% on day 730. And so the tax rate declines over the course of the second year. If you were to sell the property at the 18-month mark, for example, you would expect the tax rate under this act to be 10% on the taxable income. Taxable income under this act is defined as the proceeds of sale of the property minus the cost of acquisition of the property minus cost of improvements of the property. And then there are very specific rules in the act as to what can be included in each of those categories, what can be included and deducted from proceeds of sale, what can be included in cost of acquisition, what can be included in costs of improvements. So I won't get into all of the detailed rules there, but it is the whole scheme is set out in the act. The other nuance here is that if the sale is a sale of a primary residence of the taxpayer, and if it's a sale that occurs in the second year of ownership, so between days 365 and day 730, the owner can claim a deduction against taxable income of $20,000. That's on a per property basis. And so, for example, if the owner otherwise would have had a $50,000 gain on the property that was subject to tax, but it's their primary residence and it's in that second year, that $50,000 would be reduced to $30,000 and the tax rate would apply to the $30,000. What does taxable property mean under this act? It's defined to mean a beneficial interest in residential property or a right to acquire residential property. So again, it applies to a contract like a pre-sale purchase contract. There is a difference. Sorry, I'll get to that in a minute. So it applies to beneficial interest in residential property, right to acquire, and residential property. Notice that in this act, residential property means the housing unit, yes, but it also specifically means the subjacent land and the contiguous, like the surrounding land. So it will include the land in this case. Residential property is also defined to include bare land that's zoned for residential use. So if a property doesn't have a housing unit on it, it can still be subject to the BC flipping tax. The holding period calculation for the purposes of the provincial tax begins when the property is acquired. There's no definition of acquired, and I've come across a problem in practice here where a client acquired a property. It was not a taxable property under this act because it was a commercial property. Then they owned it for many years, and then they undertook a rezoning of the property that converted the property from commercial to residential. So now it is a taxable property. So the question is, when is that property acquired by the taxpayer? Is it acquired when they first purchased it, or is it acquired when the property became a taxable property? Our interpretation of that after looking at it was that there's no deeming rule in the act, and so it should be considered to be acquired all the way back when the taxpayer actually purchased what was then not a taxable property. There's a rule to say that on the exercise of a pre-sale contract, so if you buy a condo under a pre-sale contract and then you exercise your right to acquire that property, your days of ownership continue back to the entering into the contract. That's actually different from at the federal level. You would have a reset and a new ownership clock starting on the date again that you acquire the condo. But under the provincial act, you're considered to have owned the property all the way back to the date that you entered into the contract. There's also, very helpfully in the estate planning context, under the provincial act, there are carry-through rules for transactions between related persons. That can be a one-time transaction. So A transfers to B and they're related persons. That's both not a taxable transaction, and also B is deemed to have acquired the property back when A acquired it. So they get the benefit of that longer period of ownership. And then there's a provision for a series of transactions where you have A to B related party transaction and B to C related party transaction. And even if C is not a related person in respect of A, C still gets the benefit of being considered to have acquired the property all the way back when A acquired it.